Greetings, members, one and all of the Salivation Nation. Could we be heading back into a disaster that we saw that led to the Great Recession with the ease of the Volcker rule? And what will this mean for gold and silver? Let's explore! Yes, a member of the community sent this along to me, and others had made reference to this in the comments section of prior videos. This is something that was published late last week here. The bank stocks surge after regulators ease the Volcker rule, and it has caused the stocks to climb. JP Morgan Chase is now up 2%. This comes to us from CNBC. U.S. banking regulators are about to ease restrictions created in the aftermath of the Great Recession, a development that sent bank stocks surging Thursday. Federal Deposit Insurance Commission officials said on a call that they are loosening the restrictions from the Volcker rule, allowing banks to more easily make investments into venture capital and similar funds. The banks will also be able to avoid setting aside cash for derivatives trades between different units of the same firm, potentially freeing up billions of dollars in capital for the industry. Shares of big banks, including JP Morgan Chase, Goldman Sachs, Wells Fargo, Morgan Stanley, all names we recognize, were all trading more than 2% higher following the announcement, reversing declines in the pre-market. The move is in line with the broad push by the White House to roll back regulations put in place by previous administrations. While the banking industry has acknowledged the benefits of being required to hold more capital to cushion losses, lobbying groups and individuals, including JP Morgan CEO Jamie Dimon, have criticized parts of the post-financial crisis regulatory regime as being overly restrictive or redundant. The Volcker rule is part of the 2010 Dodd-Frank Act, which was passed in an attempt to prevent another financial crisis caused in part by irresponsible risk-taking at banks. The Volcker rule was designed to prevent banks from acting like hedge funds. The general principle is that they are allowed to facilitate trades for clients, but not allowed to strap on risk for big proprietary bets. But the rule, named for its proponent, the late Federal Reserve Chair Paul Volcker, also barred banks from making potentially speculative investments using customers' FDIC-insured deposits. That included venture capital funds, although lawmakers have said that VC industry may have been unfairly grouped with hedge funds and private equity. The change, which was floated earlier this year, will allow banks to invest more of their own capital in venture capital funds that invest in startups and small businesses alongside clients. Here we can see the Board of Governors tweet on it, that they modify the Volcker rule to improve access to capital for startups. Here is a flow chart outlining the final regulations regarding the Volcker rule. Very interesting indeed. It kind of shows you what kind of questions are answered and yes or no if it turns out a certain way. One of the things, risk mitigating hedging activities is one of the thing there, and I think the whole thing is to kind of prevent a stopgap, to prevent any kind of risk that could cause any kind of collapse or what we saw in 2007, 2008 for sure. And because risky venture capital is something that obviously is a concern for where this is going. But we're looking at desperate times, call for desperate measures, and it could be risky and it could fall flat on our face depending on how it's played out. But nonetheless, it's something to keep in mind here with these three different steps and where it goes. If activity is permitted, proprietary trading, if there's a pose a threat to the safety and soundness of the banking entity or the U.S. financial stability, and that is really the bottom line here. When it's all said and done, does the activity involve or result in material conflict and interest between the banking entity and its clients, customers, or counterparts? Or does it result in the material exposure by the banking entity to high-risk assets or trading strategy? But bottom line is does it pose a threat to the safety and soundness of the banking entity or U.S. financial stability as a whole? And that is really the bottom line. How is that question answered? Well, it's probably up for interpretation, and that's probably why they're easing some of this for the Volcker rule. Very interesting indeed. The FDIC and the Office of the Comptroller of the Currency are to set the vote on the rule changes, and the Federal Reserve and Securities Exchange Commission must sign off on it. The move to relax margin requirements for swap trades between the affiliates of the same company could free up an estimated $40 billion for the industry. But, compared to $1 trillion, that doesn't seem like a whole lot of money. The capital could be used to help bolster other parts of businesses that are now being squeezed amid the COVID-19 crisis. Sheila Bair, who chaired the FDIC for a 5-year term that included the financial crisis, called the two changes ill-advised. As a former chair of the FDIC, it won't surprise you to hear me say that the $40 billion that will no longer be in banks to protect them against derivatives exposure will likely increase risk to the government, Bair said Thursday on CNBC's Squawk in the Street. Bank stocks have been beaten down since the start of the coronavirus pandemic on fears that record joblessness will result in surging defaults on loans. The industry is also set to get the initial results from the Fed's annual stress test on Thursday, which could set the stage for potential cuts to bank dividends. You want excess capital from the system towards the end of a cycle as you are approaching potentially troubled economic times, Bair said, and now we're giving them a lot of additional capital relief, which we can talk about at the same time that we're allowing banks to continue to distribute capital in the form of dividends. So very interesting. So, on the surface it sounds like a good thing, but it sounds like it's a risk too, and some of which had led to the crisis at the beginning, and or the financial crisis of 2007, 2008. And let's say it does take the same path. We're in uncertain times now. So liquidity out there, it almost seems like this should hold off until things start to open up again and ease some restrictions and liquidity, but you want some sort of protection as well. What could this mean? Could it mean a repeat of what we had before on top of the coronavirus recession that we are in now? And keep in mind, there was a lot of money injected into the banks with the repurchase agreements, that was put in. And we have quantitative easing to infinity now. And so this easing of the regulation, what will that mean? And without congressional approval either. But that's part of what regulation is. Usually the regulations are used to implement the law. The law is relatively a general stance, and the regulations are much more in-depth and can be shifted and moved around or eased or tightened. And in cases like this, there may have been some room in the law for such a thing that we're seeing here. But nonetheless, I believe either way, in a sense, it doesn't really change the metrics of what's going on. It's just another spoke. $40 billion, you think about it, is relatively small change compared to the overall, money that's being printed and moved around these days. Although, make no mistake, it is a lot of money. But I think this is just all another reason why we should accumulate and stack precious metals at a time like this, because, things like this can happen in the blink of an eye with hardly anybody noticing, and can make things either a lot worse or marginally better. We'll see. But we'll find out. It is a fascinating thing. Paul Volcker, who passed away at a very late age, I think in his 90s, if I'm not mistaken. But nonetheless, there it is. Fascinating indeed. And what will it do for gold and silver? I think gold especially is poised to continue to climb steadily here as things like this occur. But we'll find out. Some stocks are up. The bank stocks are up. And again, a short-term fix for a long-term problem that we're going to be digging ourselves out of for quite some time, especially with all this extra debt added to the overall big number of the U.S. national debt that continues to climb. Unsustainable, unpayable, is my opinion. I don't think it'll ever be paid off at the current valuation unless they revalue the dollar. So my feeling is this probably all this stuff is happening now, knowing that something's going to have to give somewhere sometime soon. So post your thoughts below. Very interesting indeed. Thanks again for the several of you who pointed this out, and for the person who sent this along to me. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.